Google Cloud grew over 82%, its operating profit more than trebled, search grew 17%, and the stock fell over 6%. The market saw one frightening number. Google spent more cash on infrastructure than its entire business generated during the same quarter. But I think the market has misunderstood what Google is doing. It's using one of the strongest balance sheets in the history of the world to construct its way or build its way through the AI choke points. And because Google is both a buyer and a producer of AI capacity, it can monetize the infrastructure several times over. They're both a producer and a buyer, so they're able to absorb margins, use their balance sheet to construct their way out of trouble, and capture market share when everybody else is struggling. They've reported their revenue's up 24%. Search, everyone thought search was being cannibalized by AI. It's up 17%. And Google Cloud revenue has surged 82%. That's ridiculous, and it's led to their cloud operating profit more than trebling. So if their Google Cloud revenue grew 82% and their profit from that revenue grew 100% plus, then you can tell there's already margins kicking in helping the company. Yet the share price fell. So what exactly went wrong? Well, the answer isn't Google's AI strategy is failing. No, not at all. It's precisely the opposite. And because it's doing it in this way that's unusual for Google, the market's completely mispricing it. Now, this is my investment thesis. You're obviously required to do your own due diligence, do your own research, and don't interpret any of this as financial advice. It certainly isn't. It's my personal opinion on how I see the Google trade. And I definitely have got a contrarian view because I think the market has massively mispriced Google. So we'll begin with the actual results. They generated 119.8 billion in the quarterly revenue. It's just a quarter. That's up 24% from a year earlier. The Google services, $94.5 billion. Search revenue up 17% to $63.3 billion. Even YouTube's advertising revenue is up more than double-digit percentages at 13%. So subscriptions, platform devices, all of that rising. And then there's Google Cloud. But while the revenue from Google Cloud went up 82%, the profits on that revenue trebled, right? Their overall operating income rose 30% to $40.8 billion. That's absolutely incredible. And their operating margin expanded from 32 to 34%. That means it's good growth. And the headline number, even more spectacular. Net income, $112 billion. When you price that into the earnings per share dilution, that's $9.11 per share. And it's very difficult to understand quite how big that number is. 99 billion came from equity investments, right? Because they invested in things like SpaceX. If we take that contribution out of the results, you can still see like $2.85 per share over the quarter, though a healthy return per share despite astronomical spending. And that spending starting to pay off. I'm going to do so more even later. The explosion in net profit didn't then come entirely from their suddenly quadrupling the profitability of search or cloud itself. Much of that accounting gain we see on the balance sheet caused by rising equity investments, those already sitting on their balance sheet. But the gain is a real economic value. It doesn't need to be recurring operating income. That should be annualized through the cloud or whatever in order to provide a real direct benefit to their bottom line. So with all of that considered, and most of that a fairly standard diet for an investment analysts, why is it that the stock is falling? This is all about their expenditure. They spent $44.9 billion on property and equipment during this quarter, right? Property and equipment, read data center, almost exactly double what it spent during the corresponding quarter last year. Operating cash flow was $39.1 billion. Capital expenditure then exceeded the cash produced by the underlying business, right? So let's look and see how that evolves. And I predict it's going to explode. The figure is easy to find, and I'll be updating everybody on it at the next earnings report and following this stock until then to have a position. So for years, Google, understood as one of the greatest cash-generating businesses that has ever been created. It's an extraordinarily high-margin advertising machine, right? It costs very little to make a Google ad for them, and it costs you a fair whap to slap it across my YouTube videos. But attached to those software products is a very small, near zero marginal distribution cost, right? Because of the nature of search. And artificial intelligence is changing the character of the company. So again, people wondering how this will play out. It's increasingly becoming an industrial business because they're investing in the chips. They need memory, the networking equipment, and the land that it goes on, the power that generates it, and the enormous data centers that everybody loves. So every new generation of large language model creates further pressure to then expand the infrastructure again, because the demand is still there and still increasing, as you see from the results. Consequently, their increased expected 2026 capital expenditure has gone up, right? 195, it's now gone up to around 205 billion, so an extra 10 billion being spent from what was planned, and people then worrying again, how can you spend another 10 billion? You just effectively lost 5.5 billion. Does that not add up to critical losses? The previous range was 180 to 190, so it's not massively different. And they expect capital expenditure. Management have guided that capital expenditure will increase again in 2027. So no end in sight for this hemorrhaging of cash into capex, apparently. But you have to be aware of how that money is being spent, how it's being amortized, and what it means for this behemoth of a balance sheet. Investors are being asked something that they find to be extraordinary. One of the world's greatest businesses, like I say, one of the biggest balance sheets, is spending all this money so that it can develop the AI infrastructure which is required for the next stage of the AI economy, right? You spend it now, you benefit then, or you don't spend it now and you're paying somebody else to use it later. So that's the source of the sell-off in the price of Google. But it's not just emptying its bank account onto the street there, is actively mobilizing that behemoth of a balance sheet, right? It's getting the balance sheet positioned for growth in the company. In the second quarter, they raised approximately $49.6 billion, a series of common stock share sales and mandatory convertible preference shares. So they managed to raise that money from public markets, thus not a debt, and it raised approximately $20.3 billion secured notes. So that is a debt, right? But that debt is senior notes, right? They get first preference, but they're unsecured, so they're not attached to any collateral in particular at the business, right? Which has a very low impact on their share price. They've said that those funds are going to be used for general corporate purposes, right? It's for expanding their AI infrastructure and producing this global computing capacity that's available for everyone from everywhere. Now, Google are constantly having to turn down cloud contracts because they don't have the capacity to sell anymore. That's why strike when the iron is hot, and the iron is absolutely melting. Google is leveraging that balance sheet, not recklessly and not solely through debt, but through a mixture of cash and bonds and common equity and convertible preferred equity, so that that capital raise is a nice mix and doesn't create any one vector of attack on the balance sheet itself. So it's very responsible and it's not reckless. But the markets don't necessarily see that. Or the weak company would borrow money because its existing business can't support itself, right? But it's not its existing business that can't support itself that's a question here. It's the future business, which is going to capture market share, which the lowest bang for your, like the highest bang for your buck at the lowest cost per compute is spend it now and benefit later. So they're raising capital so they can build capacity while the capacity itself is scarce, so that they can then benefit from the growth of the market by capturing increased market share. So they borrow money and they grow. And they're doing that because the demand is still there. It's still exceeding the infrastructure that's currently available to supply these firms. So the capex is not being justified solely by theoretical market that may one day appear, right? It's not capital spending for capital spending's sake. It's based on already demand exceeding the current supply. So this is when you invest, this is when you expand. And if you're able to do that at a very low price of money, right? If your credit costs you very little, then why not spend it now, right? So there are both a buyer, right? Simultaneously, Google are a buyer inside the A economy, and they're a producer with Gemini. But Google, it is a producer, right? It designs its own TPUs. It develops Gemini. It owns Google DeepMind, and it operates the Google Cloud. It owns search, it owns YouTube, Android, Chrome, Google Workspace, and it's the world's largest digital advertising platform. If you don't know about earnings, you should definitely check out the Discord. You'll be able to see interesting stocks to trade that day, and it'll add to your understanding of the market narrative. This is the third most busy week in the earnings season. The next 4 weeks are going to be incredibly interesting, and we can expect a lot of main index volatility over those next 4 weeks. The point here is that don't experience the AI infrastructure as an external cost, right? That's not the way it works for them. They use the infrastructure internally, and they sell access to bits that they themselves don't use at a premium. And then they build more products on top of that, profitable products. So the spend is financed. Now you say, oh, but the operating cash flow is lower than the yada, yada, yada. But that's because it benefits Google to spend more now. And they can use the capital then to monetize their service several times over, right? Because Google uses their own TPUs to train and run Gemini. And then they use Gemini to improve search. And then they get the better search results will generate more revenue through queries. More queries going up means like, the queries increase, then the advertising slots beside it increase. So that means that they're able to monetize their queries through increased advertising. And that doesn't mean they need to put more adverts in front of any one person's face. They get the same per search that they do. So it's offering a huge opportunity to the market, which has been completely mispriced. And it's also offering these models that they're building to their own customers through the Google Cloud. So as the models improve, then their revenue improves. And it's still selling access to the underlying computer infrastructure. And their disclosures in their results specifically describe Google Cloud as generating product revenue from TPU system sales alongside their normal infrastructure. So they're managing to make money off their platform and the subscription revenue that utilizes that platform. It's just brilliant for the way they amortize their costs. So they're not merely purchasing somebody else's finished AI stack, they're making their own, improving it, and that improvement allows them to generate greater cash from it, right? This is their cash generating machine that went from search, is starting to move into AI, and it's really funding a huge growth, as we can see. It's worrying the market. So they design the silicon, they build the infrastructure, they develop the model, and then they distribute applications across it, monetizing and renting that user activity. The CEO, Sundar Pichai, described them as, this is a vertically optimized AI stack, right? The way that the vertical integration works is it creates two major advantages for Google. First is they've got control, right? Unprecedented control. They still buy large numbers of the NVIDIA chips, and they work closely with lots of different outside suppliers. But every workload that could be economically directed instead towards Google's own TPUs reduces their dependence on any external supplier, which gives them an advantage, and it allows them to retain more of the economics inside their own system, right? So that value chain rests inside Google, and they can exploit it at each level as opposed to leaking revenue out to competitors. And then it allows them to greater margin capture, right? So if a company's paying to use Google Cloud, then they're paying Google to make the infrastructure. Google then charges them for Gemini access, and they pay for Workspace subscriptions, and then they might advertise through Google, and their customers then will complete transactions through Google search and the agentic AI e-commerce products that Google's developing. So Google captures value at every stage here. multiple layers, all on the same economic activity, but on multiple layers of it, which would traditionally be going out to various different businesses, right? But Google captures all of that itself. And they're very good at that. They've always been very good at that, internalizing the value chain. It doesn't necessarily require every individual AI product to be independently profitable either, because of the network effect of these various products all supplying margin to each other. It means that if the overall system is profitable, then it's profitable enough to fund that infrastructure increasing. So, while Gemini itself could be economically worthwhile, even if Gemini subscriptions alone don't justify some of the cost of Gemini itself, it also helps protect search. And that revenue is increasing. And that allows them to increase their advertising inventory, which means that as Google Cloud demand increases and Workspace pricing increases, users are all kept inside Google's ecosystem. And so what we're saying here is that it doesn't matter, right, if one particular chatbot makes money for Google or not, but that really does matter for people like OpenAI. And so the question is, does Google ecosystem become more valuable because the chatbot exists, or is that an anchor around its neck? And if you look at it like it just needs to be there in order to support all their services, then that can be quite a forgiving framework if you're analyzing the overall health of the business. So it absorbs the cost of competition better. And then smaller companies, whose entire business depends on monetizing one single model or one application within AI, they can't possibly compete, right? So the market is still very worried, though. It doesn't mean that the market being worried when these news is so good that the market's irrational. Google are obviously building these assets themselves, which has a high cost, and those assets depreciate quickly. And then there's a question mark because Google's capex can be amortized quickly, but the market obviously it looks at this future spending projection and gets worried then when it projects that beyond the point of certainty. Say, for example, when Donald Trump is gone, will those policies change? But that doesn't change the fact that if you're spending it now, you're benefiting by the time that happens. And obviously plans can change down the road, which might then have a bigger impact on the share price. Google itself knows that these particular investments depreciate quickly, and it has identified the technological obsolescence and the point which by utilitization, the factors need to increase in order to escape that velocity. So they assess the useful lifespan of these products based on the anticipated demand before they decide to spend the money. Okay, while there isn't any guarantee that today's scarcity is going to produce pricing power for Google tomorrow, there is an opportune moment to spend the dollars which will provide greater return, and that best moment to strike is now. Google, Microsoft, Amazon, Meta, all of these companies are expanding their capacity. All of them. Everyone builds the same sort of things. Right now, there's chips that are specific to particular types of software, and these provide advantages, particular types of businesses, and some industries will benefit more than others. But if everybody builds everything exactly the same infrastructure all at the same time, then that scarcity that everything's being priced upon could eventually become oversupply. So while prices could eventually fall, and that would maybe mean that the return on investment with this particular capital spending out is different from projected, it's very possible, right? The model inference idea could become completely commoditized, right? All these models could become just as good as each other from any discernible customer perspective, who would then be, the customer then is able to, very low switching costs, they can move between these services. And that means that there would be an element of competitive pricing, which would have an impact on the projected return from the capital spend, right? So that is possible. The market's not completely irrational. Some of Google's expenditure might not create genuine new profit at all down the line. It might simply be there to defend the search monopoly that Google already possesses. And if that's the case, but one model managed to achieve a better outcome for people that have got search queries than search itself, Google could be defending its old business model, which itself knows is becoming obsolete in certain dimensions. So while they can spend the $200 billion to build this new toll road, it might not be in future that everybody wants to go that particular direction, right? It might be bypassed completely. So that's an issue. And there's a timing problem. I think this is a great time. But people look at this and they see how cash, like how capital expenditure leaves cash flow, arrives gradually. Capital expenditure leaves quickly, cash flow arrives gradually, and that leaves this period of time where less money is coming in than is going out, and that's naturally concerning to an investor. At the same time, depreciation is happening, so that continues to weigh on the reported profit for many years out after the infrastructure itself enters service. So this depreciation, right, is marked off every year on the balance sheet after you make that spend. So even if all of this investment ultimately does produce attractive returns, the financial statements could start deteriorating before those returns become visible, which would leave them in a worse economic position, even if slightly better position in the market itself, because the nature of the way that market matures and evolves, right? So all of those good things, all of those bad things, put them together and you're left with a question. The question is the actual question now, right? Because that quarter doesn't show that Google's AI policy and strategy is failing, right? It clearly does not show that, despite the fact that the market is potentially pricing that. It proves that the AI opportunity, which had become so physically and financially demanding, is now so big that even Google or Alphabet has to utilize and leverage its balance sheet in a particular way to capture it, right? Now, if even Google are having to use their balance sheet in this levered way, then that means that nobody else is able to do it, because very few people have got a balance sheet like Google. So it proves the AI opportunity is still there, and Google are the people to exploit it. Cloud growth 82%, right? And the operating income from it trebling. So management is right to say that demand continues to exceed available capacity. There's a powerful indicator that the spending is attached to real commercial demand rather than some highfalutin, imaginary, pure speculative business case. You can imagine the future as being bad, but you still have to price your products and do your research and development and invest in capital infrastructure based on the market that currently exists right now, not the one everybody's afraid of. So management's right, and those are very strong, powerful indicators, and it's the right way to be spending the money. But they are producing a negative cash flow, which is interesting, right? Double quarterly capital expenditure there. Doubled, right? Quarterly capital expenditure, twice as much as it was previously. Increased full year spending approaching $200 billion, right? Maybe $205 billion. So the market, well, it does ask, right? It does generally, the market asks, and you'll see people when you ask them, like the reasonably sophisticated investor who has a casual understanding of AI, is still right to ask, does AI produce a profit? And the market in general isn't wrong to ask whether AI creates an adequate return on the capital deployed, right? So is the return from the capital that is required able to produce a profitable outcome for the company spending the money? A lot of them are pricing that on future revenue growth that we've not yet seen real signs of in their company itself. Some of them are only buyers of chips and are exposed to changes in the technology. Others are only producers of chips and they're exposed to shifts in the demand and the nature of the industry, and the supply then might not all be required later. But Google is able to sit on both sides, right? Both sides of the AI trade, and they're a producer and a buyer. So they own the silicon, they own the models, they own the infrastructure. They are the distribution, they own the advertising mechanism that funds a lot of this growth. And it possesses the only one of these few companies in the world that have got a balance sheet that's strong enough to construct their way, to build their way through these physical choke points in the industry, which doesn't eliminate the costs of competition, right? You know, that's still there. And those costs of competition, ironically, when you see a competitor take a hit, it has an impact on Google and across the market. So that's a real concern. And when you look at the cost of competition, the sophisticated view is to look at not the direct cost of Google's domestic competitors, but the vector that presented from emerging markets, in particular China, and their low-cost large language models that are coming out of labs in China and managing to hit similar benchmarks to these Western counterparts, far lower price point. So there's a bearish interpretation that Google is sacrificing its free cash flow to defend its search, and search itself is becoming obsolete. The bullish interpretation is that Google is deliberately converting the temporary scarcity that it can perceive better than any other firm into a permanent vertical integration which will capture market share in future. And obviously the truth is that they're doing both of those things, right? They're obviously doing both of those things. They're defending the most profitable information business that the world has ever seen, which is probably a good thing, while at the same time they're building the computing utility which everybody's saying is eventually going to replace search, right? So if search is going to be usurped, if it's going to be new technology provides the same solutions that was previously done by search, and search is owned by Google, then Google will want to own that new world that emerges. And if they're using the money from search to fight these competitors who are trying to usurp them, then they've got a tap that's flowing into their side of the stream, whereas everybody else is having to pay to use that in order to develop a competitive solution, an alternative product, which is a very defensible position, and why I think these earnings were excellent. That's why I think the share price fell, and that's why I think that this quarter and the nature of those earnings and the detail between them that I described to you there is far more important than the fact whether they beat or miss. And it was a huge beat. And that's why I think the market is significantly underpricing Google. There's the Google share price, the measured move, maybe not as obvious as you'd like because I have drawn it in green and it is across the candles. But this is what it is, right? It's a right-angled broadening wedge. People get very scared of these because they are the most dangerous pattern in technical analysis. The horizontal level at the top side and these lower lows throughout, which can create a massive crescendo. The measured move at this point would take prices down in and around. So if you take it back to where prices are at the minute, right, that takes you right down to the previous low or prior oscillation low ahead of this move on Google. And throughout here, the question then becomes, price went from this low to this high, and within that, there was a large move to the top side. Within that, price action then faced the question, right? Can it go any higher? Can it go any higher than 405, right? Now, shock or spoiler, yes, it can, thanks to the Rocky Outcrop indicator. Rocky Outcrop Toolkit, you get this indicator for free as part of the Discord if you're on the supporter side, www.discord.gg/Rocky Outcrop. A brilliant group of people, and the quality of those people has never stopped increasing. This period of consolidation, what I was just describing, is what's happening here. Price is consolidating ahead of moving to the top side. And the area to beat is an area it will make it to, because another indicator you get free as part of the supporter side of Discord is the Rocky Outcrop Flash. So you look left, you can see that there's a potential for it to move down. There's a horizontal level at the top, that side resistance. When it does and breaks it, it'll go back to the prior high at 405, and then it will break that level and go on to the next one. Now, there is no guarantee of this. It's just the statistical likelihood of price. If it doesn't hold that level and breaks back down, there's this here gap. We've got it on extended hours. Go to the regular, you can see there's this gap. A lot of people are thinking, well, it's going to go there and fill that gap because prices do fill gaps. But it doesn't look like it's going to be doing it anytime soon, if you ask me. Anytime soon. Down 6.36% pre-market. You know, and you might get an opportunity now open for this thing. Or everybody else might be looking at it thinking, this is the opportunity, and they're going to buy it. It has touched the low side of that formation. It has got a higher low on the RSI. I'm not saying it's yet turned around significantly and you can judge that divergence as being real, but you know, you can see that it's very likely. If it gets down to where it did previously, these previous lows, it'll be in the extremely oversold area, right? Whereas it's very likely to bounce there rather than completely break down from that point. The strength of the move down will be at its peak. and price will not yet have collapsed. So a little bit of foot off the gas on that downward pressure, an awful lot of relief to the top side in price, and 379 from 320. That's a huge move already, right? That's already a huge move if you're trading within the formation. It's about 20%. You're looking at this gap and you're worried, right? Fine, no problem. Then you would use a stop loss on your trade, right? And the stop loss, very easy to place that, because looking left, you've got support and resistance levels within the move to the top side itself, right? Easy peasy. And here's an important one, down at around 295. So there's a horizontal level. You don't want to be holding on to the trade below that. Your entry, you would like it to be as close as possible, and your target could be the top side of resistance within this broadening wedge itself, not yet confirmed. Or you could be following it with a stop, taking it to 405. Or you could be what I'm doing, which is looking at Google, thinking, well, I love buying this thing when it's a good opportunity. It provides a brilliant risk-reward opportunity, and it always seems to pay out. I'll be looking at it around 455 long term. It's not really directly related to Google, but no single American is responsible for the state of America right now. And most of my viewers are American. I cherish their friendship and the relationship we've built over the past half decade on this channel. Now it's true that the top 1% of America owns more than 50% of all equities and all mutual funds. And that's an unbelievable disgrace. It's destroying society. But it's not the point of this video, but I have to call it out. And I know, don't take me the wrong way. If you're an American watching this, I appreciate you so much. I know that you're facing the worst of this, far greater than any of the rest of us. I know the thick end of the stick lands with you. But God's sake, it's so bad at the minute. Oh my God, it's so embarrassing. I can't believe it. I know the reason that it isn't yet fixed is because of the political apathy, because the left is also a disgrace in America. You've gone far too far into personality politics. You haven't got anybody left who's actually able to do the job properly. They've all migrated to places like Google, and so your only escape is to trade. Despite the fact that it might seem hypocritical, you can understand how money works without having to give over your own entire faith and belief to it. And that's how you make more money as a trader, by the way. Stop believing in money and instead see how money works. And I made a video 2 days ago about why your mum would be a better trader than you. And that was directly for Americans, that video. Right, so this is what Google's doing. Is in this right angle broadening wedge, that formation likely fails. Price action will move back to the top side of it. That's a 20% move itself. And the thing could actually go on and test around 455 or 450, which is a stonking trade, right? Absolutely stonking, minimal risk-reward ratio, and you've got a pretty good technical setup there coming for you, giving you that opportunity. In the 2-day time frame, you can see you're already at the top side of the bearish control zone. Moves to the top side would initially be controlled by the bears, so you'd be looking at that 4-hour resistance and cognizant of it, and the 1 hour in at around 349. And these are areas where you likely see a degree of inflection. You like 3 touches of divergence before the move reverses. It may well be that you see something like that now. So this is the trade setup. It's a stop loss, tight, measuring a level of support and resistance as we define from the nature of the move up to the top side. And that, as it happens, you draw on the Fibonacci, and though you've got multiples done for you with the RO Toolkit. And you can see they're absolutely brilliant here, where price action coming in, testing that golden pocket area, low side, up that broadening wedge. This is where prices most commonly turn around. This is where you want to have your entry, your stop. You would like to have it at a support and resistance level that's historical. It's used significantly to determine risk in markets. So you want to have a stop just below that, an entry just above these. These are the general concepts of trading. This is not a trade setup that I recommend you taking. This is just how this situation would be exploited by a trader. Typically, a good one, right? Because typically traders lose money. More than 50% of people lose money. And that's the way the world works, unfortunately, which is why wealth tends to accumulate. So maybe we need to look at the nature of ownership itself. It seems like that's a conversation that started in Britain. Anyway, it needs to start at the top end because that's where all the money is. And you're looking at this instead of just chopping people's legs off that are trying to climb the ladder, which, of course, is how governments tend to do things, right? So you're looking at a simple trading setup, well justified with fundamental analysis. The insights brought to you from my understanding of the earnings that Google just put out. Why I think the market is completely pricing Google wrong while it's approaching a technical area makes it easy to manage risk. This is an opportunity that you can take. And we do these every day. I say we because there are many of us on Rocky Outcrop's Discord, and all of us follow his lead with an absolute commitment and respect for the technical analysis, because managing risk is how you make money. We do that. We've done it for years. We do it together. We help each other get better. And you're welcome to join. If you want to be part of what we're doing here, you are so welcome. You simply need to apply to be part of the Discord, tell us your goals as a trader, and we'd love to work with you to help you achieve your goals. I'll do 3 or 4 of these a week with real in-depth analysis of the companies I'm talking about. We'll look at the charts and discuss where the trade setups are most advantageous and where risk is dangerous. And we'll also talk through the AI trade. You know, we've been covering videos. It was $9 pre-split, right? So you're talking multiple thousands of % return on that one stock. And there's many others. Many others. So we'd love to have you as part of the community. We are a very broad group that look at all sorts of different things, and you're very welcome to join. There are other trading communities. There are others, but there is nothing like the Rocky Outcrop Discord.